Let's have a little quiet. Next is Sebastian Mallaby. Sebastian, you can come on board. He's recently written one of the best books I've seen on venture capital and its role. But more importantly, he's a fellow at the Council of Foreign Relations, has covered a variety of topics, but the one I find most interesting is he was outside Nelson Mandela's jail when he was released, wrote a book. Sebastian thought his career was going to be done for being there, but he did write a book that became a bestseller on apartheid. So he's a very multifaceted person. I'm looking forward to an interesting conversation. So thanks very much. And for all the LPs, Sebastian's book on the power law, which is his book about venture capital, is in your book bags. So everybody should have that, since it was about venture capital. Maybe you could just start by giving us a little bit of a thesis on what the book is about.
Sure. So my book, The Power Law, is trying to do two things. It's trying to, first of all, explain how do venture capitalists think. Like most kinds of investor has a quantitative guideline. You think about the price-earnings ratio, price to book, whatever it is. But in early stage venture, obviously, there is no earning, right? So you can't do PE. There's no book value. You've just got what? The first VC I profile, Arthur Rock, he used to call it intellectual book value. So this is two-legged mammals who walk into your office with a dream, and you have to figure out whether that intellectual potential and the character of the people and the market they want to address, all those things which are essentially stories and impressions and a bit subjective and a bit squishy relative to other kinds of finance. So all investing is a bet on an uncertain future, but venture is especially uncertain. And how do you even begin to do that? That was the first task I set myself. And then the second was the social impact, the kind of what does it do for society? Do venture capitalists create innovation, or do they just show up and benefit from it? And I addressed those questions as well.
Mm-hmm. So tell us a little bit more. I'd like to hear if venture capitalists just show up, or...
Yeah. So, I mean, I think one way of thinking about this question is to ask oneself, why did Silicon Valley emerge as the dominant innovation ecosystem between, the 60s and 70s, right up until recently? I mean, I think now it is going global, and we can talk about that in a minute. But when I began my research, people would say to me, well, Silicon Valley, it's basically Stanford Valley. Stanford is the explanation of why there's so much innovation there. And that is simply nonsense. I mean, if you think about the 60s and the origin story, MIT was a stronger engineering university than Stanford. And if you want to throw...
Was.
Yeah, was. Okay. And if you want to throw Berkeley into the mix, we can throw Harvard. And basically, that's just not true. Another theory is defense contracts. There's a whole sort of, the secret history of Silicon Valley. It's actually about defense kind of line of argument. But there were more military contracts going into the Boston ecosystem. Vannevar Bush was Boston, MIT-based, and the military-industrial complex was much more about that Pentagon-Boston axis than it was about the West Coast. So as I began to look for a better theory, what I found was that the nature of the investors on the West Coast were just more risk-hungry, more loon-shot friendly, to borrow a phrase, yes, more, less inclined to weigh the startup down with a complex term sheet that wastes your time. And actually, from an investment standpoint, if the startup fails, you're not going to get anything back anyway. So what's the point of a complex term? So all of those West Coast risk-friendly attitudes were not replicated in Boston venture capital. I mean, since my book came out, I've been assailed by aggrieved old-timers from the New York ecosystem or the Boston ecosystem. And I have to say to them, you said you were doing venture capital, but you also said to me that it was great because you did 40 investments and none of them lost money. I mean, that's not venture capital. So I do think that, to answer this question, do venture capitalists create the innovation, or do they just show up? I think the standout performance in Silicon Valley tells us that they created it. Well, not by themselves, but that they are an essential component in the mix. And innovation comes from taking ideas and money and people and mixing that up, circulating that quickly, and creating lots of iterative experiments with those three factors combined in new ways. And the people who make that ecosystem circulate and be productive are the VCs who are incentivized, right, professionally, to get up in the morning and have breakfast with one person and then 14 cups of coffee before they go to bed. We hope they are decaffeinated, but their job is to circulate. And I think this creates this super productive set of iterative, to quote you, Vinod, the future can't be predicted, but it can be invented. How is it invented? It's invented through these iterative experiments.
Yeah, the power of iteration is grossly underestimated compared to what in most large corporations is planning. I might go to a different place than I was planning on going. One of the things that has struck me, I've been doing just innovation for 40-some years. My first startup was in 1980, my first startup in Silicon Valley. In 40 years, I can't find one example, not one, of large innovation, and we can talk about incremental innovation, but large innovation that came from an established player in the business. As I like to say, could Hilton or Hyatt do Airbnb? Could Hertz or Avis do Uber? Could Walmart and Target do Amazon? Could Boeing and Lockheed do space? I could go on for a long time. But all these large innovations, and it doesn't matter which ones you look at, not a single example in 40 years of a large innovation coming from an established player. Now, what's even more shocking, and there's some very specific scientific breakthrough exceptions to this, none of these had an expert in the area they were innovating in. So I don't know if your experience is consistent, because to me, that's the essence of the Valley. If you have an expert, they'll extrapolate the past. If you have somebody inventing from the future, they'll invent the future they want. So care to comment on whether that's...
Yeah, I mean, I think firstly, of course, I think you're right about these really path-changing breakthroughs. They often do seem to come from people who make a step from one field into another.
Well, Elon Musk in automobiles.
Right.
He'd been a software-only guy, never near an automotive startup.
I think at the same time, that's not to say that there aren't successful entrepreneurs who do a series of companies in one space, and each one takes the technology further, and that's a perfectly good way of creating wealth and driving the ball forward. So, but I think when you're looking at really path-breaking stuff, you're probably right. And the best sort of theory I can come up with as to why this is true is that it's a kind of intellectual version of the innovator's dilemma. So in a sort of corporate version of the innovator's dilemma, the company doesn't want to back the new technology because it's going to cannibalize the existing product. But in an intellectual version, we are all anchoring on stuff we've thought before, what we've said before, positions that we've taken in our professional lives, where we've thought something through and come to a view, and it's just difficult to change that. And so I think, as you say, it's the people who come out of left field, switch fields, and then they really rethink things with a fresh mind.
Yeah. So my experience, if you look at media, Time Warner bought AOL and essentially extinguished that bud. What's most surprising to me is in the early 2000s, 2004, Rupert Murdoch was deeply interested in being in this interactive space. So I spent a whole lot of time with him during those years. And in 2005, he bought MySpace, which is sort of really Facebook. But applying old principles to a new approach didn't work. even though he was hell-bent on changing his business. So that wasn't enough, and with somebody as astute as Rupert Murdoch. But media became the people who didn't know they were in media. Twitter, Facebook, YouTube, Netflix, they didn't know they were in the media business. It's pretty interesting because Netflix started in the blockbuster business.
I think one issue with the Rupert Murdoch story and in fact, most forms of corporate venture is that when you're Rupert Murdoch and you're thinking of pivoting your company, you have a pretty clear idea of what you're trying to do. You're trying to get your existing business into a new space. You see a sort of segue. And that's sort of not really how innovation often happens. Like, it's the surprises along the way. It's, you start doing something and then you pivot. And I don't think if you're anchored in a corporation and you've got a set of existing businesses, it's difficult to pivot. And it's a little bit like, the presentation we had earlier about how to do how to move from the brainstorming phase, system 1, to the organization phase, system 2, when you're preparing a presentation. In a way, you can't do system 1 if you're Rupert Murdoch. You can't have that wide open brainstorming. I have no idea how all these pieces are going to land, which order I'll put them in, because you're already committed to something.
I actually believe if society is going to innovate, it will come from startups. Worst, the example you gave is System 1, sort of not exploring the possibilities. Managers in big companies, because they don't like to fail, won't keep iterating. They don't have permission to keep iterating. And so they can't explore the space, in my view. One of my favorite examples is Tata in India used to have an award every year for the smartest failure to encourage people to experiment with things that might fail. So I always think that culture, unless it becomes pervasive and you get rewarded for smart failure as opposed to rewarded for success, big companies will not. And so innovation depends on all of these people here.
One of the things I thought about when I was working on my book is that I come out of a sort of economics and finance writing sort of background. That's what I was doing before. And there's a well-known distinction made by the Nobel laureate Ronald Coase between two kinds of capitalist organization. One is the organization you get from markets and price signals and arm's length transactions governed by contract. And the other is where you internalize those market relationships into a company and you have top-down management. And it's a different way of sort of organizing human effort to produce output. But what it feels to me like is that startup ecosystems with venture capitalists kind of at the center of the network are a third pillar of capitalism. Because they have some elements of like top-down direction. Like in a big company, there's a R&D director or a strategy director who is thinking about, okay, we're going to move the company this way. We're going to do this research experiment. We're going to put this person and this person on it. We'll give them some money to pursue that. That kind of top-down stuff is a function of the venture capitalist who is choosing projects and then helping to suggest people who won't be hired to the new startup. So there's that strategic side. But then, like in the other part of Coase's duality, there is a price signal because the runway runs out and the startup goes back to the capital market to raise the next tranche of capital. And if there's no buyer, then that's a market signal and the company will probably close down. And so it's that mixture of market signals on the one hand and top-down direction which makes this a third pillar for Coase. And I also think that it's an increasingly important one because why intangible capital is more and more important. When the economy is based on physical goods, you often want a big corporation that has a big ability to raise capital to go build a factory or whatever it is. When it's software or some other intellectual property, pharmaceuticals, it tends to be done better through these iterative experiments and not in a corporation. That's the nature of discovery of intangible capital.
Moving on, you talk a lot about power law investing. And we should get the book to everybody, not just the LPs, but I thought the LPs would be most interested in this. But talk about power law investing versus sort of normal distributions and normal investing.
Well, I mean, the obvious thing is simply that in a hedge fund portfolio,
you might start by explaining the power law, because some people may not be familiar with it.
Yeah, because I think the simplest way I've found to describe is to begin with a normal distribution and then say why it's different. So in a normal distribution, it's the familiar bell curve distribution, meaning that the mean is the same as the median. The middle of the distribution is right on that average, and most observations in the set are around the average. So you get that bell curve where everything clusters in the middle. So an example would be that the average American man is 5 feet 10 inches tall. 2/3 of American men are between 6'1" and 5'7". An NBA player who is 7 foot is really quite unusual. And furthermore, actually 7 feet, well, it sounds like a lot, but it's quite a small deviation, 20% or something from the average, right? So if you have a cinema, you've got 100 men in the movie theater, and the NBA player is bored by the movie, and he gets up and walks out. The residual 99 men, their height hasn't really changed, right? It's now 5 foot 9 inches, 9.9 inches or something. Now, in a power law distribution, it's not the height of American men you want to think about, it's the wealth. And if you think about that movie theater, and there's 100 men, and Jeff Bezos is bored by the movie, and he walks out, the average wealth of the residual man is going to crash. Why? Because it's not clustering around the average. Instead, you've got these outliers in the right-hand tail who make, 10x, 20x, 30x, like way more, and they dominate the total returns in the distribution, and they pull the average to the right away from the median, okay? So that's a power law distribution. You get it, like sometimes people call it the 80-20 rule, 20% of the cities have 80% of the people. The Pareto Principle, it's called after Wilfredo Pareto, who noticed that I think something like, 80% of the peas in the garden were being grown on 20% of the pea plants. So you see this in the natural world as well. But in investing, this is what marks venture out from other kinds of investing. In a hedge fund portfolio, the notion that you would have bets that go to zero, that would be career-ending. I mean, that's a disaster. You make a stock market bet, it goes to no, it doesn't happen. In venture, of course, things that go to zero are perfectly normal. And you and your partner, John Doerr, used to say with great happiness, you can only lose 1 times your capital. Well, I mean, tell that to a hedge fund guy. Losing 1 times your capital on one is just not what they want to hear. So they're just looking for, they're picking up nickels and dimes in front of the steamroller, right? They're trying to make small profits on each position. Whereas in venture, it's about you make 10 bets, and 7 or 8 may do nothing much, but 2 or 3 are going to change the world. It's just a fundamentally different way of coming at things. And I think it drives, it's not a natural mindset. Mm-hmm. And that's why, for a long time, Silicon Valley had kind of a monopoly on this way of thinking about things. And that's why Boston didn't get it. And New York, maybe with the exception of Venrock and then later Union Square Ventures, didn't really get it either. Europe didn't get it for sure. But what's happened in the last 15 or so years is that the Silicon Valley firms went to China, then they went to India. Now they've moved into Europe. They're obviously in Israel. And this thing is being spread all over the world. And I've done presentations to groups in Africa, to Latin America. I mean, I'm convinced that we're at this inflection point where this power law mentality is going global.
So we'll get to that in a minute. One of the things that frustrates me is when venture capital gets lumped in under private equity. In venture capital, private equity, hedge funds, how different a culture and cultural differences have you seen as you talk to people, the language used, the approach they use, how they invest?
Yeah. Well, I mean, the first distinction is, I wrote this book earlier about hedge funds. And when I wrote about hedge funds, there was this joke that people made about Louis Bacon, a great macro trader, who did very well, and he bought himself a private island. And people said, Well, that won't make any difference. He's so insular already, this sort of Oz-like figure hidden behind his bank of screens, not talking to people, and basically, reading stuff and figuring out his view on what the yen would do. That is a sort of insular thing where you don't want to talk to other people about your idea, because then the trade will be crowded, and it's dangerous if you're in a crowded trade. It's difficult to get out. So hedge fund people are super analytical, and they are quite introverted on the whole. They don't talk to other people much, and that's what they do. Venture, of course, you'd have zero deal flow if you didn't go and meet people. It's all about networking. As I said, it's making that network circulate, the ideas and the money and the people, by being out there and meeting and sharing ideas and brainstorming. That's the essence of being a venture capitalist. So it's diametrically opposed. I throw in one more thought about growth investing, right, which is this sort of in-between type of thing, which, again, people lump in with venture. But I think if you look at the culture of Tiger Global, who I write about with some respect in my book, I wrote before the recent collapse. I still respect them, by the way. But it's different. It's very different. It's basically, instead of the search for sort of early stage alpha, in other words, finding entrepreneurs and ideas that are really going to have a chance of breaking out and changing the world and doing 20x, it's about harvesting later stage beta, right? Of like, how fast can you deploy? You just take a view that like, tech is great. Tech is going up. I want lots of tech. I want to deploy millions of dollars in tech, super fast, super efficient. And you're not really selecting so much, because the selection has been done for you. You're only investing when this thing is a unicorn and it's already got traction and product market fit, and the managers are obviously not idiots, because otherwise they wouldn't have gotten that far. So it's a very different type of investing. And when Sequoia, who I write about quite a lot, made the transition from early stage only into growth investing, it took them about 5 years to get it right. And the first couple of funds were disasters. And they told me funny stories about how they completely failed the first time. Then they brought in established growth investors from a firm called Summit, brought them into Sequoia. But there were the venture guys who had the dream gene, and they were thinking about possibilities. And then there were the kind of spreadsheet people who were looking at existing revenues, and they just couldn't talk to each other. And so it took them a while to figure out how to blend those two cultures.
By the way, we don't do IRRs ever in our investments. In fact, we may be the only investment firm that doesn't look at IRRs. We say we're really doing option value investing, buying options on large outcomes. How important, which is sort of the definition of a power law, how important is power law investing, and to whom, and for whom?
Well, first, it's important for society, right? We want technological progress for all the good reasons that you know, and I don't think you get it without the power. I mean, without that mentality of like it's okay to make 10 bets, believing and hoping that all of them have a good shot at working, but knowing that most of them won't. And that is as I said, not a normal way of thinking about the world, but without it, Silicon Valley, I don't think it would have happened. It was not Stanford, it was not defense contracts, it was this power law mentality. And you see it even in like Arthur Rock's writings in the 60s when he created the first successful West Coast venture fund. He didn't use the term power law, but he basically understood it. And in the lectures that he gave that I was able to unearth, he talked about it without using that term. So I think it's super important for society. It means that venture investors really need to lean into risk. And it means that entrepreneurs have to be super tenacious and tough and courageous. And they know that it could be huge or it could have to be closed down. I think this gets me to one point I think I'll make quickly, which is that when I give this some version of this talk in Europe, I get this pushback where people say, well, Sebastian, you've told me a cool story about how innovation happens in Silicon Valley, but it's never going to work here in Europe because we don't have the same mentality. We think here in Europe that if we fail at something, it's actually a failure. Somehow in Silicon Valley, they're drinking this weird water, and when they fail, they think it's a learning experience. And I explained to them, it's not the water. It's that, it's a repeat game. I hope I'm not saying something you guys are going to violently disagree with, but it feels to me like in Silicon Valley or in the American tech ecosystem, the first startup may not work, but you can do another one. Why can you do another one? Because the venture investors are smart enough to understand that one failure doesn't mean you're a bad entrepreneur. And that turns a sort of single game, which is frankly would be too scary to undertake, into a repetitive game, which is still tough and daunting, but you can get your head around it.
1% of the companies that get started every year raise venture capital. They account for 75% of the market cap. So that is the power law in operation. And all these entrepreneurs have real responsibility for societal innovation because it wouldn't happen or happen very slowly without them. So real burden on all of you guys. But let's go to, you brought up Europe. We like to say Silicon Valley is not really a place, it's a culture. And I have found European investors, even venture capital investors, frustrating, and they take a great opportunity, increase the probability of success by being super conservative, and reduce the consequences of success to inconsequential. So they have these small returns and small huts, so they turn great ideas into decent ones. And this always comes up when we talk about can venture capital happen in other places. I've noticed huge differences. Shanghai, it's a very active ecosystem, so it's proof it can happen. There's a different kind of ecosystem in Australia. Sorry, not in Australia, in Israel, where they think a certain way. It's much more insular, but it is entrepreneurial. And I would challenge that it's easy to replicate all over the world, though it is happening. Bangalore's working somewhat, mostly in more conservative, smaller outcomes. So what have you found?
So I'll tell you a story which happened after my book came out, and somebody who read my book in Bangalore got in touch. This is a general partner with Accel Capital. And so we were chatting over Zoom, and he introduced himself, and he said, well, I was in the US for a long time. I went to MIT, I worked at Intel, and then I came back in 2010 to India, and I started doing this venture capital investing in Bangalore. And I'm a historian, so I'm always interested in knowing how things change. So I said, OK, 2010 you come back, now it's 2022. Tell me in that dozen-year period, how has it changed? So he says, OK, I'll explain. So when I began in 2010, I made some investments, and after a bit, one of the founders I had backed came to me and said, I need your help. So I'm a venture capitalist, and I understand that I'm a service guy, so I say, sure, I'm here to help. What do you want? And the founder says, I want to get married. And the VC says, so why are you coming to me about that? You want to marry me or what? And the founder says, no, I want to marry my girlfriend, but her father thinks that entrepreneur equals loser. And so the father is saying, no marriage, no can do, can't marry this guy, he's a loser. But, says the founder, you, Mr. Venture Capitalist, you've been to MIT, you've been to the US, you've worked at Intel, you have standing and stature. And if you call up my prospective father-in-law and explain to him that entrepreneur does not equal loser, then I will be able to get married. So the VC thinks and says, well, OK, I'm a service industry, but marriage intermediation services I didn't really expect to be doing, but hey, whatever. And he makes the call, explains that entrepreneur doesn't equal loser, the marriage goes ahead. So I say, OK, that's a good story. How is it today in 2022? And he says, well, today, all of the prospective father-in-laws are watching Shark Tank on TV in Hindi. And so the moral of the story is that culture changes. This is super important. Culture can be anti-entrepreneurial in 2010 and pro-entrepreneurial in 2022. And I think that's the thing we have to keep hold of. When we think about Europe, when we think about Israel, Australia, whatever you want, things can change. If you go back to Silicon Valley, before it was called Silicon Valley, right, in the 1950s, when Fairchild Semiconductor was founded, right, by these traitors leaving Shockley's lab and going off and founding Fairchild. The classic business book of the 1950s in the United States was Organization Man, right? This description of the white-collar culture where you join when you leave college, you work loyally until your 60th birthday, and then you retire with your gold watch, okay? This was not an entrepreneurial culture. And the reason that they were called the traitorous eight is because it was traitorous at that time to leave another company, right? So somewhere out of something, an entrepreneurial culture was created in Silicon Valley, I think by venture capital. And so as VC spreads around the world, as it becomes real VC, not this fake sort that you were referring to where they try to take the risk out of everything, but when proper VCs, maybe with Silicon Valley DNA, come to London or Stockholm or whatever, they are moving that culture over and they are going to spread this way of thinking about stuff. And you've got in Europe tons of good engineers. You've got a very rich consumer market. What you need is the culture and the attitude, which I think VCs are going to bring.
Mm-hmm. John Doerr and I used to have our favorite phrase for many, many years. We worked together for 20-some years, actually longer. It was, we want to dare entrepreneurs to be great, and you almost have to challenge them to think bigger. I actually think that's my principal job, push every entrepreneur to be as great as they can be.
I'm looking around the room. I mean,
yeah.
you know.
Well, many will say to
pain
the
in the
point,
neck. Pain in the neck?
Yeah, pain in the neck and the point of discomfort of how big can you think. In the other thing that I think is tolerated well in Silicon Valley is hubris and bravado and arrogance, which is just part of the entrepreneurial personality. And people don't understand when a Larry Page or Elon Musk makes these hubris statements. They just, if they didn't do that, if they were smart, if they were pragmatic, and they wouldn't go attempt changing the car industry. That's just not a pragmatic thing to try and do. So
there are personality types. I don't think the Collisons are quite like Larry Page or Elon Musk in their
no, Collisons are very different.
Yeah.
They're much more quiet.
Yeah.
Good friends, and a good investment an awesome investment for us. We were very early in that one. Let me, I know we are running short of time. You've talked about another factor about what becomes a location for venture capital or venture startups, which is network density and the porous nature of ecosystems. Talk a little bit about that.
Well, I think you need a big market, right? I mean, to make the power law work, the upside has to be really big. And for it to be big, in general, it's useful to have a big market. So I think the reason why China took off in the way it did is because the market was so big, it was growing so fast, and
and competitors weren't allowed.
Yeah, that too, absolutely. But I think market size is important.
Yeah.
And I think India has an advantage there, and that's the limitation of Israel.
Yeah.
And that basically in Israel you make great tech coming out of military stuff, and then you bring it and sell it to the US. And so Israel is almost like an adjunct of the US tech ecosystem because, as I understand it, people around Series B, Series C, once they've got the product, the engineering team stays in Israel, but the marketing is in the US and the funding becomes US. So I think market size is important, and I think network density matters, but I think remote communication technologies have changed that, and I think it's interesting that whereas the way the US innovation ecosystem grew up was super concentrated geographically, China is more dispersed. You've got Shenzhen, Beijing, Hong Kong, Shanghai. It's a bit spread out. Europe is pretty spread out.
They're doing a pretty good job of trying to kill it, but
yeah, right. That's another story. But I think what you're seeing in the newer tech ecosystems, as well as in the US today, with I have to say Miami because in case Keith is here somewhere, but certainly Boston is growing, New York is growing, Austin. So I think it's spreading in the US, it's spreading out in Europe, it's spread out in China, it's a bit spread out in India. I think this Silicon Valley density is no longer necessary because we've got all these remote tools.
You've also talked about sort of imitators of the venture style of investing. Let's flip it the other way and talk about what an outstanding firm does. That's different, because you talk in your book about the various firms and how their cultures led to more or less success. And then I want to follow that up or with what an outstanding country does, because this is about societal innovation.
So I might illustrate this with Sequoia, if that's all right here.
Sure.
Because I spent an enormous
They're
amount
good
of
friends.
time. I had a lot of access there, and I ended up understanding their process quite deeply. And what was funny about the process of doing my book is that, when I first came to the Valley and I did the first kind of 25, 30 interviews, I would have these conversations with people where they would say things about, I would ask, so why did this investor connect with this entrepreneur? What was it? What was the idea that made them connect and made the investment happen? And I would often be told these sort of cute stories which were just like meaningless, right? So, Patrick Collison of Stripe told me, I went to see Mike Moritz, and, I went there by bike, I always do, and, I parked my bike outside the Sequoia office. I go in, I talk to him, we have this nice talk about growing up in Ireland. He grew up in Wales, me, Ireland, similar story, and then we walk out the front door, and he sees my bike. And I'm like, yeah, so what? He sees my bike, and he says to me, what's your fastest time on the old La Honda climb from whatever it is, the Portola Stone Bridge, or, And Patrick gives his time, and Mike is impressed by the time, and he thinks, oh, I must have passed a test. I must have this, passed some kind of...
Entrepreneurs push themselves.
Yeah, gritty personality, sort of whatever. And it's a nice story. I don't really think that that's how capitalism works or that venture gets allocated. But as I got closer to Sequoia, I understood the real reason why they invested super early in Stripe, which is that they had systematically extended their network by cunningly, first of all, having a very close relationship with Y Combinator, so that when Paul Graham, who knew Patrick very early on, Patrick would sleep on Paul's floor when he was being interviewed by different US universities when he came to the US from Ireland. They had connected over email with coding questions that Patrick was posing about Lisp. So Paul, knew Patrick first, and then, Patrick wanted to raise a Series A, and the first call Paul made was to Sequoia. And then another connection was that Sequoia has this Scouts program, which was a deliberate tactic for, even though they had a terrific network, making it even better. And they created the Scouts program, and an early scout was Sam Altman, who also knew Patrick, and the first call that Sam Altman made was to Sequoia.
Sam is CEO of OpenAI, which was the demo you just saw. One of our largest investments, actually.
So I think that the first answer is how do the best VC partnerships do so well is that they consciously think about entrenching their networks, extending their networks, and getting the best funnel. Second thing is, once you've got a great funnel, you've got to choose the deals. How do you choose the deals? What they do is they impose behavioral science on their Monday morning partner meeting. And a very obvious example is, well, let's take one. So people anchor, as we've been saying, on what they've said before. And so if you turn down the Series A, you're probably going to turn down the Series B, not because you should, but because you're reluctant to admit that your Series A judgment was a mistake. And so they had to consciously recognize that and fight that anchoring. And there's a bunch of other behavioral distortions that they fight. Third thing is you've got to add value after the deal. Now, some VCs that I've grown friendly with, like Peter Thiel, actively have argued that you shouldn't bother with adding value after the deal. I think that's a pretty extreme and eccentric position to take.
One I disagree with completely.
Yeah. And I think, frankly, my recent conversation with Peter, I don't think he believes it either, really. He's sort of saying it slightly to provoke. which is, of course, what Peter does.
It's a good excuse to not do any work.
Well, he has a plausible story that, in a parallel world, to be the outlier that really makes it, you've got to be super contrarian, and therefore any kind of normalizing influence from an investor who has pattern recognition around what might have worked before is probably negative. That's his story. I think it's too extreme, and I think he knows it's too extreme. Anyway, Sequoia tries to add value. That's the third thing. And then the fourth thing, which I really didn't think about before I began these deep interviews with different partnerships, is that the internal culture of the partnership really matters a lot. Like, are the individual partners lone wolves that go out and eat what they killed? They go find entrepreneurs, they try and bring the deal in, they do the deal, they go on the board. If it goes public, they capture some of the economics, they capture all of the glory, and that's how it works? Or is this really a team where they help each other and the sum is greater than the individual parts? And I think, Sequoia really goes out of its way to nurture the new people they hire as investing partners. So Roelof Botha, who is now the senior steward, the kind of top guy there, began, aged 30 or 29 or something at Sequoia, having been the CFO at PayPal and having been a star at Stanford Business School. So an incredibly promising resume, but he'd never made an investment before. So when he brought his first deal in, it was a remittances company called Zoom with an X at the beginning. He was approached by Pierre Lemond, the oldest partner, who said, look, let's do a deal here. You found the company. You should get the credit if it works. But if it doesn't work, we don't want to mess up your reputation by having a failure on your resume. So we'll go there together. I'll be the board member initially. You'll learn a few things about how I do this. If it's going to work, we'll flip positions. You get the credit. If it doesn't work, it'll be my mistake, and I'll take the hit. I don't care. And so they really went out of their way to nurture Roelof. They did things like they would get a new investor, make him sit down and say, Mike Moritz would do this with people. Show me your calendar. How did you allocate time? Did you take this meeting? What did you get out of this meeting? Could you have done this one by telephone? You did this, but should you have done more of that? So this very detailed attention to highly intelligent, productive, professional people who could just be even better. So I think it's that investing in each other, which is the fourth magic ingredient for partnership.
So the same question about countries. And I want to get to the last point since you're at the Council of Foreign Relations, and it's sort of, I think, one of the more important issues. Do countries do certain things really well to succeed in this area? Are some countries much better than others?
So I think the biggest government mistake is to pour a ton of money into venture partnerships sort of for too long. Israel did it temporarily in a carefully limited way, and it worked. But I think Europe, there's evidence that having the government as the major LP in a lot of venture partnerships mean that there isn't really a drive for return. So you just get a lazy ecosystem. And good VCs run away because they're competing with this subsidized money. So that's not the thing to do. What you want to do is you want to have clear tax and legal structure for limited partnerships, which is the best structure for venture capital. Capital gains should be relatively friendly, the tax rate. And then you sort of get out of the way and you just do a couple of things, or maybe three things. You invest a lot in basic science. So you pour money into research at universities in basic science and funding for PhD students. So you have a big pipeline of skilled people. And you make the tech transfer office of the universities friendly to the companies that want to spin the tech out into a startup. Those are the three things. After that, get out of the way.
So my last question, I'll take a few questions from the audience, so get your hands ready. I think one of the largest, so the US has lots of domestic issues, left, right, polarization. We can talk about it for a long time. But the thing I'm worried about, the more important question facing the US and Western society in general, I think, in the next 15 years is a large techno-economic war. and that will determine regional influence, first over Southeast Asia, extending all the way into Africa and others. And I think it will be a techno-economic war, not a traditional military war. Do you agree? And does the entrepreneurial ecosystem, because innovation depends on it, have a large role to play, or would you just say that's not true?
No, it's totally true. So, clearly military power is based on technology. That's always been true. And we're going through this big technological shift. There's going to be AI-dominated battlefields. And as somebody was saying earlier today, maybe it was you actually, the US could do more in terms of incorporating AI into weapon systems. Big aircraft carriers with, hugely expensive, human-piloted F-16s is not, against swarms of autonomous drones, that's not a good strategy anymore. And so we need to go through
There's a good book on this called The Kill Chain for anybody who wants. It's a very good book about how the nature of war has to shift, but I was talking less about war than economic influence. By the way, Graham Allison has a great book called Destined for War about the US and China, both highly recommended readings. But let me go back to you.
So I would say, first point is, tech is important for the military technology, but also, if you just think about the economic power of China without Huawei, it would be less. If you think about US economic power without, pick your big company, it would be less. These companies generate dual-use technologies, which have both commercial GDP growth kind of benefits as well as direct military benefits, and both of those things translate into national power. So, whereas Wall Street finance has negative externalities for society in the sense that banks take a taxpayer-funded backstop and then make a whole load of bets and want to be bailed out if it doesn't work, so it's costing society something. Venture capital and tech has a positive externality because there are all these spillovers into the rest of the economy which are good for growth and good for living standards and good for defense. And so you want to basically support that and cherish it, which is why I think you should make a lot of, spend a lot of money on the pipeline of science that's going to feed this ecosystem. I also think, though, that there's a UK-based professor who's Mariana Mazzucato, who's written about the entrepreneurial state and all that, who pushes this argument like ridiculously far, who says, the real venture capitalist is the government. And the government invented the internet. Yes, sort of. Maybe DARPA did the internet, but when DARPA handed that over to the private sector to do, UUNet to connect up normal people, and then Netscape to make it usable, that was venture capital that did that. And before the venture capitalists got involved, how many people were on the internet? I mean, 100,000 or something, right? So I think it's this alliance that makes for national power, national prosperity, and national defense. This alliance between government science and private science.
Let's take a few questions. Drew?
So can you talk a little bit more about the venture and entrepreneurial ecosystem in China and compare and contrast it with here in Silicon Valley?
Yeah, one of the most amazing things about China, which I certainly didn't expect to discover, was that I'd read Kai-Fu Lee's books, and he tells a story about how the government was very supportive in getting the Beijing AI stuff accelerated, and he tells a story about the kind of entrepreneurial state in China. And I accepted that China has state capitalism, and I was expecting to find that when I went there. When I went there and hung out with people, what I discovered is that every single well-known Chinese tech company that got going and became big, Sina, Sohu, NetEase, Alibaba, Baidu, Tencent, EachNet, you name it, right? All of them had American capital without an exception. They were structured by American Silicon Valley lawyers with dispute settlement in New York and a Cayman Island parent so that you could have equity options for the employees. You couldn't do that under Chinese law. So the entirety, basically, of the successful part of the Chinese tech ecosystem, entirety may be too strong, but the preponderance, really, was created by importing the Silicon Valley venture model, including the legal structures, and dropping them into China. Now, if that's the case, which I'm convinced that I document that it is, it follows that when China starts to have a heavy-handed state now, you shouldn't be a Kai-Fu Lee and say, oh, well, the state knows what it's doing, and it's going to be fine. No. The reason why China did well in consumer internet is because it was a fairly free market type of system. And I think the kind of politicization of that world is going to be bad. And I do believe that there's momentum in tech innovation. Once you've got a whole bunch of smart people working on a lot of smart projects, that momentum will carry on. And so I don't think China's going to hit a wall and just disappear as a tech power. But I do think there'll be attrition because of the political clampdown. And the signals in the last 3 months or so are that they have understood that, and they're kind of trying to dial back now on how much they clamp down on tech.
Other questions? Yes. Up.
Should I speak loudly? Repeat the question. You did
Oh, he has a mic.
Oh, thank you. Thanks for your time. You did a tremendous amount of research on this book. What surprised you the most over the course of all your research across firms, geographies? What's one kernel that really took you by surprise?
I mean, before I said what I just said, the thing about China being so VC-driven, that was a big surprise. And it was a surprise in the sense that it kind of, by the time I actually committed to writing the book, I had done enough research already to understand that I didn't believe that MIT was less good than Stanford in 1970. So I kind of expected to find that VC would be at the center of the story in the US innovation growth. I didn't expect to find the same thing precisely in China. So it was like a confirmation of my view that what really drives innovation is these iterative experiments which are facilitated by VCs being at the center of an ecosystem of gutsy startups. So I think that remains the biggest surprise.
There's a question in the back there. Oh.
So I'm curious, is there a ceiling on venture capital? Because there's a limited number of people that are able to make companies, et cetera, or maybe there is, maybe there isn't. But I'm curious as to what's the maximum percentage of capital that can be VC? Is there a point at which you kind of get foie gras, you get a little bit sickened liver by overeating?
I think you can grow the ecosystem too fast. If in a boom cycle like we've seen in the last 3 years or 2 years, that's what happens, right? Money floods into VC, and the money exceeds the number of entrepreneurs with great projects, and you get overvaluation. So for sure, in a short-term sense, you can have a foie gras problem. In a secular sense, I think it's okay because, every time you have, if you think about Europe today, Spotify is worth whatever, 50 billion, something like that. That has this huge magnet effect for other people who are going to go and start new startups. So the success of the ecosystem draws more people in steadily, and so you can steadily grow it. And so I think VC can carry on growing in a steady fashion. The problem is that there will be these moments when capital lurches in and you'll get a bubble and bust. But the trend line is great, and I don't see why that would stop. And because of the rise of intangible capital becoming more and more important, I think that just carries on growing.
Are there other questions? Oh, Saf.
Can you talk a little bit about either one or both of you, venture and entrepreneurship in India? And is there a structural issue there that I heard different versions of this issue that managers at companies can be personally liable for products or failures, and that reduces incentives for risk-taking? Maybe you want to take that?
We've not done a whole lot in India. We've done a few things in India. I do think there's some structural issues, but I think the much larger issue is much more conservatism about the kinds of companies people want to build. Now, having said that, I think that's starting to change. So last night, I was talking to Peter Beck, the founder of Rocket Lab, and he was lamenting that there are just no startups in New Zealand. And he's based there, and I was saying, don't be surprised how many 18-year-olds you're influencing today as a role model. And they'll, like I did, at 16, I fell in love with the idea of starting a company because of a Hungarian immigrant, Andy Grove, coming to Intel. That was sort of how I fell in love with the idea. That he will become a role model for young people coming up, and they will start to change their career goals to starting something. I think that's happening a lot in India, and it's accelerating because of successes like Flipkart and others. And slowly, the structural elements are being dismantled, but it does slow things down when that, today even direct equity investing is hard, so you have blocker companies and sort of other messy structures. But I would say because of democracy in India, I think it's more likely to have an emergent ecosystem over time. That plus great role models, whether it's Flipkart or Paytm or pick your favorites, that ecosystem is and those founders are investing then in other new founders. So it takes time. It takes 10 years for a company to mature and another 5 or 10 years for others, for them to start investing actively and train people, as you said. So I do think that's happening. Question over there?
Yes, just thumbing through the book here as you were talking, and I was looking at the chapter on luck and skill, and just wanted to get your observations as you were writing that chapter around luck and skill with VC firms and just being in the right place at the right time, and also just the application of the power law to VCs that kind of rise to the top in the industry. Just love to get your thoughts and observations on that as you were writing that chapter.
Sure, a great question. So luck and skill. I almost didn't write the book because I thought the luck theory couldn't be disproved initially. And then the kind of tipping point was when I thought I could disprove it. Because if it was just luck, I wouldn't be interested in writing about it. If it's skill, then I want to explain the skill. And I tell you my thought process on this. So why is luck persuasive? Because the answer is that, reputation matters in VC. So there are these feedback loops where you do a great deal, the company has a great exit, the VC gets some credit for that, then there's a halo effect, more good founders come to that VC, the deal flow is better, therefore the VC continues to do well. So you could tell a story where the initial first deal is lucky, and then path dependency kicks in, and it's just luck. And there's this experiment I found kind of interesting, which I describe in my conclusion, where a social science experiment at Columbia University, I believe, where you take a bunch of songs, like 20 songs, and you run an experiment where you get somebody in and say, okay, you listen to the songs, you download or you like the 2 that you prefer. And then somebody else comes in and they can see which ones have been liked. And there's a certain amount of suggestion and social proof. And so at the end of this experiment where you've had 500 people come and look at the songs, there's one song that's like the smash hit. It's by far the best song. It's got it's a power law distribution. So it's got most of the credit has flowed to 1 or 2 songs. So you think, wow, those songs might be outstandingly good. So now you do the whole experiment all over again, same songs, but just a fresh group of participants. And again, you get this power law distribution. There's this song that's brilliant, and it's much better than everybody else, but it's a different song. So that shows you how this feedback loop world could, imagine that there are 50 venture capitalists. They all show up in year 1. They all make some investments. By the law of probability, a couple of them get lucky, and then the path dependency kicks in. So why is that not a full explanation? The answer is, first of all, that the path dependency in venture capital exists, but it's not all that strong, actually. There have been academic studies on measuring this stuff, and the probability that if you get an IPO in one of your investments, in like your first 10 investments, that a later investment will IPO goes up, I think it's like 1.6%. So it's a small improvement, not a big one. And if you just think anecdotally, and I have an appendix in my book with a chart on this, like if you look at the 60s, 70s, 80s, 90s, you split up venture into different time periods, the dominant companies do shuffle. Kleiner Perkins, I'm afraid, went to being #1 in 2001 to not even in the top 10.
That's because I left.
I think that's a partial but not totally adequate explanation.
Just kidding,
there are
just
a few other
kidding.
things too. So I debated this long and hard with your former partner, John Doerr, and of course he's not happy, but it's the truth. The truth is that, you know, any credible ranking of the top 10 venture capital companies in 2020 excluded Kleiner Perkins, although they had been #1 2 decades earlier. So, you know, path dependency is not an adequate explanation for why some firms do well for a long time. So when you observe that Sequoia is an outlier and has been in the top 3 all through its history for like 60 years, that's skill, right? And then you go speak to them, and you say, well, what's the playbook? And after a couple of cute stories that are distractions about bicycles, you get the real story. You say, yeah, that is skill. You know, applying behavioral science to your decision process, deliberately extending your network, working on your internal culture, that is skill, right? So I come down with the view that it is definitely skill-driven, even though a power law distribution has the feature that when somebody goes like this, their outcomes are total failure, total failure, total failure, jackpot. It looks like Las Vegas, right? But it isn't Las Vegas, and that's why I wanted to do the book.
Well, this is a good place to stop. So thank you very much, Sebastian, and thank you, everybody.